Taxes are one of life's two certainties, but for the ultra wealthy, they seem more like an optional suggestion. While the average person watches a big chunk of their paycheck vanish in the taxes, the rich are out here keeping most of their earnings and growing their fortune. But how do they do it? Today, we're diving into the legal strategies and tax loopholes the wealthy use to minimize or even avoid paying taxes altogether. This isn't about shady offshore accounts or illegal schemes. Everything you'll learn here is perfectly legal and might just change the way you think about tax. By the end of this, you'll see why the tax code isn't really broken. It's just designed for those who know how to play the game. Hey, what's up you guys, and welcome back to my channel. I'm Dr. Furrukh, and I'm here to help you achieve financial independence, build wealth, and live life on your terms. If you're ready to take control of your finances and your future, you're in the right place. I'm a first-generation immigrant who started with literally nothing. My journey began in high school with a simple t-shirt business that I grew in high school and later sold in college. By the time I turned 30, I had done over $10 million in gross sales and launched multiple successful businesses in retail, fitness, e-commerce, and even consulting. Today, I live life on my own terms, and I'm excited to teach you how to do it too. On this channel, I share you the tools, the strategies, and the mindset it takes that help me build success from the ground up. Whether it's real estate, growing a business, or tackling financial challenges, you'll find actionable steps, real-world insights, and the motivation to create your dream life. If I can do it, so can you. So hit that subscribe button and join me as we work toward financial freedom, step by step. Let's build your legacy together, and let's jump back into today's topic. Number one is capital gains versus income. The average person earns most of their money through wages, which are taxed at some of the highest rates, up to 37% in the US. The wealthy, however, structure their earnings through investments, which are taxed at the much lower capital gains rates of 0 to 20%. This difference is one of the biggest reasons the rich keep more of their money. Here's how it works. Instead of earning a salary of $1 million and paying taxes of $370,000, the wealthy invest their money in stocks, real estate, or businesses. With these assets increase in value, they pay capital gains tax only when they sell, if they sell at all. Many wealthy individuals hold their assets for years, avoiding taxes indefinitely. For example, imagine buying $100,000 worth of stock. If it grows to $200,000, the profit isn't taxed until you actually sell it. And even when you do sell, the maximum tax rates on that gain is far lower than the rate on your regular income. Here's a fun fact for you. If you earn less than $44,625 annually as an individual, your long-term capital gains tax rate could be 0%. That's right, 0. Working for a paycheck is like rowing a boat against the current. Capital gains are like adding an engine, and the wealthy are cruising on yachts. How this affects you: shift some of your income into investments, even if you start small. Over time, you can benefit from lower capital gains rates instead of relying solely on wage income. Number two is borrowing against assets instead of even selling them. This strategy is so brilliant, it's almost unfair. Wealthy people don't need to actually sell their assets to access cash. Instead, they borrow against their investments or properties, unlocking liquidity without triggering taxable events. Here's an example for you. Imagine someone owns $10 million in stock. Instead of selling it and paying capital gains taxes, they go to a bank and they take out a loan using the stock as collateral. The bank gives them cash at a low interest rate, and they use that money to fund their lifestyle or invest further. Since loans aren't considered income, they pay 0 taxes on that borrowed money. This strategy is even more effective because the rich can negotiate extremely low interest rates, often lower than the ones that you see on TV, the returns that their assets are even generating. Meanwhile, their assets continue to appreciate, making them even richer. The rich borrow money to live, the rest of us borrow money to survive. How this affects you: if you own significant assets like a paid-off home, you can access cash through a HELOC or other loan products, which allows you to maintain your investments while gaining some liquidity. Number three is depreciation loopholes. This is a big one. Depreciation is one of the most lucrative loopholes in the tax code, especially for real estate investors. It allows the wealthy to claim a tax deduction on assets that are technically losing value. Over time, even if those assets are actually increasing in market value, for instance, if someone owns $1 million apartment building, the IRS allows them to deduct the property's depreciation over a set period, usually 27.5 years for residential real estate. That deduction reduces their taxable income, even though the property itself may be appreciating significantly. Depreciation doesn't stop there. It also applies to equipment, vehicles, and other business assets. Savvy business owners and investors use use depreciation to wipe out large portions of their taxable income while still enjoying the full value of their assets. Depreciation is like telling the IRS your car is a beater even if you just upgraded to a freaking Ferrari. How this affects you. If you own rental properties or other depreciable assets, consult a tax professional to maximize your deductions. Depreciation can significantly reduce your taxable income and help you reinvest in more assets, keeping more money in your pocket. Number 4 is using tax-free accounts. Tax-advantaged accounts are the bread and butter of wealth building strategies for both the rich and the average person. While most people focus on traditional retirement accounts like a 401k or IRA, the wealthy use a wider array of tax-free or tax-deferred accounts to grow their money. For example, municipal bonds are a popular choice for the rich. The interest earned from these bonds is often exempt from federal and sometimes even state taxes. This makes them a safe, tax-efficient way to generate some income. The wealthy also take advantage of health savings accounts or HSAs, which offer a triple tax benefit. Contributions are tax deductible, the money grows tax-free, and withdrawals for medical expenses are tax-free as well. The rich save for retirement in tax-free accounts. The rest of us save in coffee cans labeled hope. How this affects you. Max out your 401k, your IRA, or your HSA contributions to take advantage of tax benefits. Municipal bonds can also be a great addition to your portfolio if you're looking for tax-free income. Number 5, we have carrying forward losses. Tax loss harvesting is a powerful strategy that allows the rich to use their losses to offset future gains, minimizing their taxes. And here's how it works. So imagine someone sells an investment at $50,000 loss. They can use that loss to offset $50,000 in future gains, reducing their taxable income. If they don't have enough gains to offset immediately, they can carry those losses forward indefinitely, reducing taxes year after year. This strategy isn't just about minimizing taxes, it's also about being strategic about the reinvestment. By selling underperforming assets, the wealthy free up capital to invest in better opportunities while lowering their tax burden as well. Losing money on purpose might sound crazy unless you're rich enough to turn it into a tax advantage. How this affects you. If you have investments that aren't performing well, consider selling them strategically to harvest losses. This can reduce your tax bill and free up cash for smarter investments. Number 6 is charitable donations. The wealthy are known for their philanthropy, and while giving back is great, it also comes with a significant tax advantage. When the rich donate to charities, they receive tax deductions that reduce their taxable income. What's more, they often donate appreciated assets like stocks instead of cash. By doing this, they avoid paying capital gains taxes on the asset's growth and still get a deduction for a full market value of what they donated. Many wealthy individuals go a step further by setting up their own family foundations or donor advised funds, DAFs. These allow them to control how their donations are used while reaping immediate tax benefits as well. For the rich, donating to charity isn't just about giving back. It's about giving less to the IRS. And how this affects you. You don't need billions to benefit from charitable giving. Consider donating appreciated assets like stocks or mutual funds to maximize your tax savings. Number 7 is reinvesting through like-kind exchanges or 1031 exchange. Real estate investors love the 1031 exchange, a tax deferral strategy that allows them to sell a property and reinvest the proceeds into another property without paying capital gains taxes. Here's a general gist of how it works. If someone sells a rental property for $1 million and uses the proceeds to buy another property for the same amount or more, they owe no taxes on the sale. This allows investors to trade up to better properties while deferring taxes basically indefinitely. The 1031 exchange is like Monopoly. You can trade properties all day and never actually pay the banker. And how this affects you. If you own investment properties, a 1031 exchange can help you grow your portfolio without being hit by taxes every time you sell. The wealthy don't avoid taxes by breaking the rules. They avoid taxes by understanding them. Strategies like capital gains, depreciation, and tax-free accounts aren't reserved for billionaires. With the right approach, you can use these tools to reduce your tax burden as well and grow your wealth legally. So, which strategy surprised you the most? Let me know in the comments below. And if you found this video helpful, hit that like button, subscribe to the channel, and ring that notification bell for more financial insights. Remember, the tax code might be complicated, but it's designed to reward those who know how to use it. Let's learn the game and keep more of our hard-earned money for ourselves and enjoy financial independence. Thank you.